I'd like to call the May meeting of the Opebt Trust to order. Good morning, and our first item is to approve the minutes of the meeting of February 11th, 2019.
Second.
All in favor?
Aye.
Any opposed? Okay, the next item is the presentation of the investment performance review period ending March 31st, 2019.
Good morning, Madam Chairperson and trustees. In front of you, you'll have our large book. I know that we are, the agenda says about a 2/28 monthly report and then a 3/31 monthly report and then also an April 30th report. But since the first two I mentioned there are replaced by the big report, we'll cover the big report and then the April 30 update, if that's all right with everyone. I don't want to be redundant here. So when you're looking at the big book, the March 31 update, market environment, market is very strong during the first quarter of this year. When we're looking at year-to-date returns, we're very positive so far this year and have, as of today, we have wiped out the losses of the fourth quarter of last year, which is a pretty scary moment. We're kind of seeing a little volatility in the markets today. I don't know if you saw that, but the trade issues keep cropping up, and with deadlines and retaliations happening, it's probably going to be par for the course. And that's not going to be an easy negotiation to resolve. It's probably going to take longer than everybody expected to. Because there is a tremendous amount of face trying to be saved or taken, and then also there's a lot of dollars at stake as well, and yuan. So that I would expect that to go on for some time, and it's just the nature of bilateral trade and negotiations to be that way, especially when it's two countries that consider themselves to be superpowers. Looking at the first page on page 2, though, you can see performance on the upper right-hand side of major asset categories. International equities, that top group, these are in U.S. dollar terms. So the ACWI ex-U.S., that's all countries, except for the United States, was up 10.3%. IFA, our developed markets, up 10%, and emerging markets up 9.9%. So good results there. Some volatility and dispersion, but very strong results. The second set of columns there, the blue, the dark blue, and light blue, U.S. equities, and you can see how strong results were there. For the quarter, this is a quarterly return, not a yearly return. This is January 1 to March 31st. So the S&P was up 13.6, comparable returns everywhere, mid-caps up even better than that at 16.5%, and Russell 2000 up 14.6. And while those returns are great, those look like one-year rates of return. And you look down at this next segment there, the green, the bonds, those look like one-year rates of return too. Looking at how strong the recovery in all of these categories are. Looking down at the 1 year, you can see the big dispersions. You can see international equities still negative. U.S. dollar strength is really hurt when you're trying to translate returns back into U.S. dollar terms. But we still have high single-digit returns on the equity indexes for the trailing 1 year, and that includes the 20% negative return during the fourth quarter of last year. And bonds roughly stable. So looking at the following pages, I'll quickly go through this. The highlights are growth is continuing to beat value. Value investors are becoming more creative and finding cheap companies. If you look at the page 4, you can see returns for the Russell 1000 and 2000 for the first quarter and the trailing 12 months. You can see very strong returns here. The 1 year are the pink returns. You can see that there's only 2 sectors for the Russell 1000 that are negative, and that's going to be financials and materials, so highly cyclical companies. And technology continues to perform very, very well. I don't know if you saw, but Uber went public on Friday. Lyft went public a few months ago. So we're seeing some of these multi-billion-dollar companies that were supported by venture capital moving into the public space, as well as a variety of other companies out there. So a positive are a healthy IPO market. Another positive is mergers and acquisitions are happening. And a third positive are earnings are coming in at a lower rate of increase than last year, but they are still increasing right now. So economically in corporate finance world in the U.S., we're strong. I wouldn't project the returns we earned during the first quarter through the rest of the year. It's simply too much. We need to have reasonable expectations. International equities are shown on page 6. You can see the various sectors. Not a lot of differentiation. Some of the indexes. You can see how close they are for the quarter, or for the U.S. dollar and the local currency during the quarter, but you look over the last 1 year. The dark blue are the returns in U.S. dollar for the 1 year, and the light blue is in local currency. And what this means to us as investors is that the U.S. dollar was very strong over the last year, and so that means if you invested in foreign stocks, then that penalized you. Oddly enough, if you're investing in foreign stocks, you want a weak dollar because that increases your rate of return, whereas a strong dollar depresses your rate of return. And then fixed income on the following page here on page 8. Quarterly performance very strong across the fixed income spectrum. And you see for the trailing 1 year also very strong, but you see that the two negative returns there on the last 1 year, global aggregate bonds. So these are bonds denominated in non-dollar, and it was hurt by the same currency translation effect. So page 10, here's the trailing 1 year rate of return as of March 31, 5.7%. It's looking much better this quarter than it was just a quarter previous. And on page 12, you can see a relatively new display here showing the total market value at $59.2 million as of March 31st. The gray set at the bottom there shows you what the total contributions have been over time, minus withdrawals. So this is the cash in, cash out over time. And as you follow this across, beginning market value of $6 million, contributions of 64. So we have significant contributions coming in, but almost half of that has been withdrawn out as a pay-as-you-go type system here on an Opebt trust. We have generated gains of $18.5 million. Those are real dollars. And we have an ending market value of 59. It's a little bit higher than that today. As we go across, the percent return over this period of time is we're getting close to 100% return. And this is a time-weighted rate of return. The income over that period of time is an additional $5.4 million, which, again, that's spendable, and we like that. And the income as a percentage of the beginning market value is 90%. So just out of income, we have almost put in as much as the initial contribution to the trust itself. So hopefully this paints a good picture of the actual dollars ins and outs. Page 13 and 14 are asset allocation. You look at the number here, March 31st, $59 million. We started the year at 52. And if we go to page 16, you can see that there was $1 million contribution. There were some transfers within the portfolio's investments. We had $252,000 of income. That number is increasing dramatically as the size of the trust keeps increasing. And we had appreciation of $5.5 million during the quarter. That is a fantastic quarter for a portfolio of this size, and I don't think earning $5.5 million is ever a bad thing. So going on to pages 17 and 18. For the quarter, the total fund, net of fees, was up 11% for the quarter, and that ranked in the second percentile of the peer universe. So you outperformed 98% of funds of this size, which is under $70 million. That was a fantastic rate of return. If we look down, we see that the fixed income was very strong with Loomis up 5.22. Double Line outperformed its benchmark, but more modest amount. Lord Abbott, was up 7.5% with their high yield bond portfolio. Hoisington was up 5.39. When you look at the Vanguard 500 index, 6th percentile with a gain of 13.62. Our mid-cap index was up 16.72 for the quarter. Our Hotchkiss & Wiley mid-cap value fund was up 16.17% for the quarter, ranked in the first percentile. Stevens small-cap growth was up 15.4%. Again, these are fantastic absolute rates of return, and most of them were very good on a relative basis. Causeway was up 10.29, which outperformed by a modest amount over its benchmark. So what we see here is really good asset allocation. We see great asset allocation. We see good manager selection, even though sometimes those manager selections are going to passive investments. And we look at the overall risk-adjusted rate of return. This is probably the best quarter that we have seen together as a group. Looking at across the board there, year-to-date, same figures. 1 year rate of return is 5.7%. That's the 10th percentile. For the 3 years, annualized at 9.79%. and that is above the policy index, and it is above the actuarial assumption, and it ranks in the 3rd percentile of this peer universe. So over the last 3 years, we've made very solid strides on relative rates of return and also on absolute rates of return. And if you look down the list on that 3-year time period, you can see that most of the returns that we have are very good in absolute and in relative terms versus benchmarks. I mean, just going down the list, Loomis Sales Bond, 1st percentile, Double Line, 8th percentile, Lord Abbott, 14th, Hoisington a little bit lower there at 40th, our Vanguard 500 index at 4th percentile, Vanguard mid-cap at 25, Hotchkiss & Wiley, remember they're volatile, they're in the 71st percentile, and you see Stevens at 18% annualized rate of return, net of fees, 18%, the 39th percentile. And then Causeway, our cautious value-oriented international, is 6.33%. So talking to your managers, I was actually in Houston and met with folks at Stevens on last Thursday. They continue to make good progress in their portfolio. They're buying stocks that they think are growing quickly but not yet detected by most other folks out there. Quantitative process, I met with their technology, energy, and healthcare analysts and came away with a positive outlook from that meeting. Again, they're not investing in the super go-go companies out there, but they're trying to find companies that have greater growth potential than most people realize. I think the individual manager sheets are no surprises here, continued strength through the portfolio. I think on page 28, given that it is a large portion of the portfolio, the index, the 500 index, 4% turnover, very low fees. The portfolio itself actually holds 515 stocks, even though the index holds 505, it says here. But what they're trying to do is guess in very small parts the companies that are about to be put into the index because they have good performance characteristics in that fact. But just looking at the names here, Microsoft, Apple, Amazon, Facebook, and Berkshire are the largest holdings. Microsoft at 3.7. Apple has since regained the lead because they've performed much better. I believe that's true. But 3.3%, then Amazon at 2.9, Facebook at 1.7. And Berkshire Hathaway, that's Warren Buffett's company, old line value investing, but not exclusively in old line companies because at their annual meeting, not this weekend, but the past weekend, mentioned that they had finally taken their initial position in Amazon, which is, you can see, 2 spots above them in the rank order here. Berkshire Hathaway is effectively a holding company, a very long-term hold, and one that a lot of folks look to for some indications of future performance. Looking on the other pages here, Hotchkiss & Wiley, they're interesting investments during the quarter, a lot of energy, even some non-dollar denominated energy companies. Again, they look predominantly in the United States for value, but their notion is to find value wherever they can. Looking the other pages here, page 34 is American Beacon, the small cap growth fund, again, actively managed. You look at the names here, 104 holdings of the portfolio, PE ratio is high, but they are buying growth companies. They even do pay a little bit of a dividend yield, but you can see the earnings growth here, the 5-year earnings growth is 24%. So they are truly buying small companies that are growing very, very quickly.
Doug, I have a question.
Yes.
On Hotchkiss and Wiley.
Yes.
You mentioned that they are volatile.
Yes.
So what makes them that way? Is it their significant energy and financial holdings?
Mm-hmm. That's a great question. There's several levels to it. But to start is one, they are not as benchmark sensitive as other folks out there because volatility, for better or worse, is traditionally measured relative to your benchmark, right? So they think that that's not the most effective way to actively manage portfolios. And given that they are such long-term investors and I would say they are very convicted investors once they find companies that they like, they're not afraid to step into sectors like financials or energy where they see significant market dislocations. Right now, if you look at the market, there's a lot of industries that are very richly valued right now, technology, healthcare, et cetera. Energy is about the only place that most of the market is very, very negative on. And, you know, these are not what we would call long-term investors, they just know that energy has been a tough place to be since 2015, and so it takes a while for folks to warm up to it. And what Hotchkiss wants to do, they want to get in front of that, right? So they see what the rest of the market dislikes intensely, and they invest there after they find companies that they like and managements that they can trust. So when you see the volatility here, volatility, not all volatility is bad, right? The first quarter was highly volatile for them, but on the upside. Again, and this is not remember we put a passive offset to this manager just because we had full force of that volatility in the past on the downside, and I like the structure now. But it's not, they seek to take advantage of the volatility by providing capital to parts of the market that are unpopular. And sometimes they can get a little bit ahead of that, meaning that they're buying stocks as they are going down. But that's one of the advantages of being a value investor, is that if you buy shares in a company and it goes down, you can buy even more. And if you thought it was attractive at the first price and it goes lower, you can buy more at the second price. And they dollar cost average into a lot of these positions. But their turnover is 32%. I mean, you look at some of the names here. CIT Group, you remember that was a consumer finance company that almost went bankrupt. Popular, I think I've mentioned that one before. That's the largest bank in Puerto Rico, right? And Puerto Rico is not necessarily a stability, one of the most stable places in the world, but as far as banking, they have one very large bank, and it's used by a lot of folks who live on the mainland also to give money into Puerto Rico. So it's a story that has a couple of layers deep, and that's traditionally where you will find most of their holdings, several layers deep. But yeah, financials is always going to be a big piece. It's not always banks. They do a lot of work in the insurance area, which is tough to understand, right? It takes a while to get up to speed on those companies, but they're willing to do that for long-term returns. That was a lengthy answer. Was it a sufficient answer? Thank you. And the next few pages here, I think Causeway, it's always one to look at. International equity is kind of treading water right now, even though it was up 10% during the quarter, or 15% during the quarter. 10. Treading water. You look at the large holdings here. Again, this is a more traditional value equity shop. They do have some emerging markets exposure, and that's good. We like that. But you look at the names here, Volkswagen. They bought Volkswagen when they had the emissions scandal, right? So it's a traditional value investor also. Lind, Takeda Pharmaceutical, Prudential, Unicredit. So they do have some of the exposure to large European banks, which are under some pressure, and that's why they find them attractive. But then you also see a China Mobile company there. And if you look at the largest holdings in their benchmark, it's skewing more and more over to China. So just because they're value-oriented doesn't mean that they're not intrepid in finding new companies and new opportunities. Next few pages, I think, want to highlight on page 40. Again, this is a correlation matrix. This describes the performance of the investments versus each other. This is a 5-year look back as of March 31. And what we would like to see, what we don't want to see is all of these columns, all of these cells displaying 1.00, because that means perfect positive correlation, which means that you have zero diversification. So when we're looking through this, and I'll draw your attention to row E. So that is the Vanguard 500 index. That's the large cap portfolio. So you go across and you read, so they've got a 0.7 correlation with Luma Sales. That's fairly high, but Luma Sales invests in a lot of corporate bonds, so that's not unusual. Double Line is a more macro investor, 0.17, so they have a lower correlation there. And then Lord Abbett High Yield, 0.76. Again, all corporate bonds, so that's understandable, but still there is diversification. Then we look at column D, negative correlation with Wasatch, Hoisington. That's the all-treasury portfolio, and that's the main reason we have them there. Then as we go down that list, D, where it intersects, I know this feels like playing Battleship, but row F, column D, you'll see that is Hotchkiss, negative correlations. Down the rest of that list, I'm sorry, on the Wasatch Hoisington, and really that's what we want to see. We want to see negative correlations where we have, and even during the first quarter, all of the portfolios had positive rates of return. So this is a 5-year look back. On the next page, we have our manager status summary. I recommend no changes to this. Again, keeping Causeway on the watch list because of their performance. Not a burning issue right now. It's one to remind ourselves of. And then on page 42 is our expense ratio versus peer universe. So the total expense ratio here based on Morningstar data is 55 basis points, and that's a weighted average of all these categories. If you had the category average in each of these rows, your expense ratio would be 93 basis points. So that's a difference of 38 basis points, which if you take the current market value is about $139,000 per year. So we're performing very well. We have some active management. Active management is doing well, starting to come around again, but overall the portfolio is not sacrificing quality for lower cost. And then the asset allocation on the next page, page 43, you can see we're very close in all categories here. Again, this does not show the cash held outside in the checking account, I guess you would say it. But this is just the investments of the trust. And that concludes the very thorough review of the quarterly report. Positive quarter, good results from our active managers and our passive managers.
Are there any questions for Doug? Hearing none, we'll move on to the next item, which is to receive the monthly investment flash report as of February 28th, 2019, March 31st, 2019, and April 30th, 2019.
Excellent. You'll see the April 30 report. I want to go to that. Everything else is redundant to what we've already spoken about. Pleased to get this to you last Friday, and it was great that it can make it into the report. You can see on the market environment page, the next slide over, you can see the 2019 market monthly index total return performance. It's the table there below the two charts. So Russell 1000 was up an additional 4%, Russell 2000 up 3.4 during the month, international equities 2.64, and again, the only loser here that we see is the non-dollar bond index, which we have no dedicated allocation there. So going over to the year-to-date, 18.6% for the Russell 1000 through the end of April. So we're not going to be aggressively pushing for more equities for now just because the market has been so strong. If we can, we will realize profits in this, or if we need to contribute money to the trust, that will be going towards fixed income because we're at the upper limit of our target allocation. And the reason that we have that target allocation is to not get carried away and to take profits from the performing assets and give it to the underperforming assets. And then on the next page, you can see we finally closed above $60 million. So ended the month. I know there's been a lot of contributions here, but the portfolio has increased by 10 times since the initial funding. And that is the percent return, 99.1% again over that period of time. That's that is a substantial gain. And you can see that our market value there of contributed assets, net contributions is 40.7. So we want to continue to grow the gap between those. But again, we need to be reasonable about our expectations. The total fund, another fantastic month, up 2.84. So we go to a year-to-date return. This is a calendar year-to-date of 14.2%. And our one-year rate of return is 8.17. So we're above the actuarial assumption for the trailing one-year period of time. Looking down for the quarter, you can see the bond portfolios, different levels of strength here. The Hoisington portfolio, remember that's our shock absorber to risk, actually traded off during the month, down 2.5%. But our equity portfolios also performed in line, if not above the index. In fact, look at the Stevens was up almost 6%, while its index was up 3%. So another very, very strong month for the trust portfolio.
Okay, are there any questions for Doug on the flash report?
I have just one question, and it's not on the flash report, Doug. I should have asked this a moment ago. When we were looking at the correlation, and some of these are pretty highly correlated, is there anything that we need to do, watch for? Because I'm looking at, I know the negative correlation is ideally where we want to be. And I'm looking at some of these that have a correlation of like 0.82, 0.87. Sure. So what can we do to make sure that we're not like overexposed in a certain
Sure,
sector?
that's a great question. What I would like to, and I think I can do this, I think I can add a total fund rate of return, or total fund row on here to tell us how the individuals are correlated with the mass, and I think that's good. Honestly, when we're looking, and these numbers, it's really hard without the background, without me explaining it better, what a good correlation is. So generally amongst U.S. equities, diversified portfolios will correlate between 85 and 90 with each other if it's all U.S. equities, right? So that's anything below that, you're getting really good diversification, one versus the other. But when we're looking at our bond portfolios, I think our bond portfolio is doing a fantastic job, both as individuals and as a group as far as their correlation. I know when I look at the Loomis sales correlation with the S&P, it's 70, right? That's pretty high, but Loomis invests in corporate bonds. And when I look at the Lord Abbett high yield portfolio, 76, it seems a little bit high too, but again, those are all corporate bonds, so it is a little bit higher. What I would like to, something to watch for is amongst, say, like the Hotchkiss mid-cap and the Vanguard mid-cap, so that's F and G, right? So when I see that they're both investing in mid-caps, their correlation is below 90. I think that's pretty attractive for being the same somewhat size of companies out there. That tells me that the two are not duplicating each other's effort. They're investing in mid-caps, so there's going to be some commonality there, but 0.87, when you see a correlation of 95 and above, that means they're pretty similar to one another. But when we're looking at this, that's an attractive. Those are the two I would worry about the most. Duplicating. And then, so also F and H, if you can follow those, 0.79, so that's our mid-cap and our small-cap growth. I think that's attractive, one versus the other. If you look at one other thing here, let me see if I can find it. It's in the quarterly report, but it's the previous page. And these are quarterly rates of return. It's the chart, like this.
Which page?
I'm sorry, it's 39. So these are the major asset categories, major equity allocations. And this goes back 10 years, right? So this is in addition to some of the investment that we have here. So you see the equities, and there's quite a bit of correlation there, especially when times get very difficult. You go to 2011, we had a sell-off that year. One positive aspect of correlation is you see the purple line there. That's our Hoisington. That's the all-treasury shock absorber portfolio. All the equity portfolios are down and down significantly, but you see that portfolio up. I even look at the market today, and I see the equity portfolios are all down 2%-ish, but you're seeing the Hoisington portfolio up a lot today. So that portfolio works best when everything else is worst. I think, and it's a great question. Thank you for asking that one because, again, it's the individual investments are important, but it's how we combine them, which over the long term helps us. And one of the things that I like about the way this trust operates is that we have the regular addition to and removal of contributions and distributions, which allows us to go into the underperforming assets just prior to them outperforming. Thank you.
All right, so our item is to receive the monthly investment flash reports for February, March, and April. Can we get a motion on that?
Second.
All in favor?
Aye.
Any opposed? Okay, our next item is discussion and consideration of approval of additional asset allocation or changes to portfolio fund managers as recommended by the board or the investment consultant. I didn't hear anything in our discussion that would lead me to believe that we were discussing that today. So if there's anything that any of the trustees want to add to that? And the consultant? Okay, so we'll move on from there. The next item is acceptance of the interim financial statements for the 9 months ended March 31st, 2019. Good morning, Rhonda.
Yes, I'm Rhonda DeGone. I'm from Accounting Services. And I would first like to direct your attention to page 5. and that is the statement of planned net position. The trust reported a net position of $62 million. It's an increase of almost $6 million over the prior year when the net position was $56 million. I will note that Doug mentioned that the investment balances were $59 million. The difference between the 59 and 62 ending in March 31st is the portfolio handled by Treasury of just over $3 million. The next item I'd like you to take a look at is on page 6, and that's on the statement of changes in net plan position. And the trust reports $1.5 million in investment income as of March 31st, as compared to the $3.7 million reported in March of 2018. And that's primarily due to a decline in the fair value of the investments, offset by the interest and dividend increases received in the current year. Employer contributions and plan member contributions remain stable this year as compared to last year. And benefits paid for premiums are up $1 million this year from the $17.22 million reported last year. Administrative expenses are up $17,000 from the $61,000 reported last year. And this completes my report, if there are any questions.
Are there any questions for Rhonda? Hearing none, I'll entertain a motion to receive to accept the interim financial statements.
Second.
All in favor?
Aye.
Any opposed? Okay. Our next item is to approve the renewal of the agreement with BOKF for custody services, retroactive to May 9th, under the same terms and conditions as approved on May 9th, 2016. And we have Bob available to answer any questions if there are any. This is a fairly routine item.
Second.
All in favor?
Aye.
Any opposed? Okay, our next item is to approve our external audit contract between the Benefits Trust and Allen Gibbs Howlick, an audit firm for fiscal year 2018-2019. And we have Rhonda here to answer any questions that might come up from this. Again, a fairly routine item.
Second.
All in favor?
Aye.
Any opposed? The next item is to approve an RFP for investment consulting services.
Second.
All in favor?
Aye.
Any opposed? Our next item is to approve the FY 2020 annual budget, establishing revenue and expenditure budgets, and Doug Dowler is here to present the budget to us. Good morning, Doug.
Good morning. I'm pleased to be here to present the budget that our office, as well as the Personnel Office and Treasury, have worked together to put together. You'll see it's a fairly small change, in fact, a slight decrease to $29.3 million is the budget for FY20. It's a decline of about $133,000. And even though it's a very small change, there's a number of things moving inside that total number that affect the bottom line. One of the big shifts is in the participants switching from the indemnity and UHC plan to the Medicare Advantage plan. We've had a significant shift in membership there, which has lowered the premiums for health insurance. We've also had a slight decrease in the number of participants in the program, and so that's reduced our premium costs there by about $1.6 million. One thing that has been added in the current year, in the FY20 budget, is the funding for the clinic, the CARE ETC clinic that is here in the Arts District garage. This is the first year that the retirees will they've been granted access to that, and then we're now funding that through the trust. We're sharing that cost between active employees and retirees and splitting that cost proportionally there. So that's a new cost that you'll see under professional services. That's an increase there. And then finally, the city has kept its contribution to the Opebt trust level at $14.5 million. Even though the premiums and the cost for health care have gone down, the city's maintained that contribution, so there'll be a little larger increase to our reserves for future expenses going into the trust. That, along with the interest received that we budgeted, are expected to add about $2 million to the trust bottom line for the coming year. So that's kind of a quick overview. I'd be happy to answer questions that you may have about the budget. Again, a very slight change overall, but some significant changes on the underlying areas there.
Are there any questions for Doug? No? Hearing none, I'll entertain a motion to approve the FY20 budget.
Second.
All in favor?
Aye.
Any opposed? Okay, our next item is to ratify the claims listing.
Second.
All in favor?
Aye.
Any opposed? Last item on our agenda today is reports or comments from trustee, staff, and interested parties. So, Diana, anything?
I just want to extend condolences to Ted Carlton, one of our trustees. His wife passed away last week. Funeral services, I was told, were going to be private, but we do want to extend our condolences to Ted and his family.
Any other comments?
No.
No? Staff? Meeting is adjourned.